You know that feeling.
Huh.
Staring at these super complex financial documents, trying to make sense of it all. Every line, every number.
Oh, yeah.
Especially when taxes get involved, feels like you're trying to, I don't know, decode some ancient, really technical language.
Yeah.
Where the numbers are speaking in riddles sometimes.
Absolutely. It's exactly that moment where a company's financial reality, the one its investors see, it kind of clashes with its tax reality, the one the IRS sees.
Right.
And that disconnect, it's not just a headache. It's actually where you often find the deepest insights into how a company really works financially. They're kind of hidden in there.
And that is exactly why we're here. Welcome to The Deep Dive, the show where we take these really intricate sources, cut right through the jargon, and give you the core insights you need to be, well, truly well-informed.
We do the legwork for you.
We take the shortcut for you,
Yeah.
Uncovering surprising facts and making even the really dense topics, hopefully genuinely engaging. Today, we're taking a deep dive into one of the most critical and honestly often misunderstood forms for corporations, Schedule M-3. We're talking specifically about the one for Form 1120 here.
Right.
And this isn't just about, ticking boxes on a form. It's really about understanding these fascinating, sometimes pretty stark differences between how businesses see their profits internally.
And how the IRS sees them for tax purposes.
Exactly.
Yeah. Our mission today is really to unpack this essential document. We want to illuminate how a company's financial statement net income gets painstakingly reconciled to its taxable income.
Okay.
And crucially, what these differences actually mean for, well, your organization's tax obligations. It's kind of a journey into the very heart of corporate financial reporting and tax compliance.
We'll be exploring those common areas where these two worlds, diverge, helping you grasp the nuances that can really impact a company's bottom line.
Absolutely.
Yeah.
Let's get into it.
All right, let's unpack this. So let's start with the core mission of Schedule M-3, bridging these two distinct financial worlds. Why do we even need this reconciliation in the first place? What's the fundamental disconnect between financial and tax net income that makes this form so indispensable?
That's really the foundational question, isn't it? And it's a great one because it highlights this kind of dual identity that most corporations live with.
Okay.
On one hand, you've got the financial statements. These are prepared for shareholders, investors, creditors, the public, you name it. And they're governed by accounting standards like GAAP in the U.S. or IFRS internationally.
Right, the rules everyone agrees on for reporting.
Exactly. The main goal there is transparency, giving this accrual-based picture of the company's economic performance, its financial health. Think of it like the company's report card to the world.
Right, so it's about giving a clear, consistent picture of the company's health to anyone who has a financial stake in it, focused on presenting that true and fair view, as they say.
Precisely. But then on the other hand, you have tax returns. And these are governed by a completely different set of rules at the count, the Internal Revenue Code.
Ah.
The rules here are designed primarily to calculate tax liability, and they often differ, sometimes significantly, from financial accounting rules.
How so?
Well, for example, financial accounting might aim for, say, smooth, consistent reporting of earnings over time, avoid wild swings, while tax law might prioritize immediate revenue collection for the government or maybe incentivize certain economic behaviors like capital investment through faster depreciation.
Ah, okay, different goals.
Different objectives naturally lead to different rules for recognizing income and expenses. It just makes sense.
The distinction really clicks. It's not about one being right and the other wrong, really. They just serve different purposes.
Exactly.
So the why is that these two systems have different objectives, and because of that, different rules for recognizing income and expenses. Which brings us right to the purpose of Schedule M-3 itself.
The Schedule M-3 is the grand translator, you could say. It's the reconciliation statement that bridges these two financial realities. It takes that financial statement, net income or loss, what the company reports to its investors, and meticulously adjusts it line by line, detail by detail, to arrive at the net income or loss for U.S. taxable income purposes.
So it's not just a summary.
Oh, no, far from it. It's a detailed, almost forensic bridge. It shows every single step, every dollar of difference between the financial books and the tax books. The IRS actually designed this form specifically to increase transparency, make it easier for them to spot potential issues or maybe aggressive tax positions.
And there's a crucial link here, too, isn't there? It's not just some standalone document floating out there. It actually feeds into other parts of the tax return.
Correct. Absolutely critical link. Schedule M3, Part 1, line 11, that reports the net income the income statement of only the includable corporations for tax purposes. That number ties directly to Schedule M2, line 2, which is net income per books. Then, Parts 2 and 3 of Schedule M3 take that adjusted financial net income and reconcile it further, step by detailed step, to the final taxable income. The number reported on Form 1120, page 1, line 28.
Wow.
This whole comprehensive link ensures there's a complete and auditable trail. It gives the IRS a roadmap, basically, from a company's public financial statements right down to its ultimate tax liability.
Okay, so who exactly needs to wrestle with this detailed form? Is it every single corporation, or are there specific triggers that put Schedule M3 on a company's, must-do list?
Yeah, it's definitely not for everyone. The general rule is pretty clear, actually. A domestic corporation or maybe a U.S. consolidated tax group filing Form 1120, that reports total assets of $10 million or more on its Schedule L, that's its balance sheet per books at the end of its tax year, must file Schedule M3.
10 million. That's the magic number.
That's the threshold. And it applies whether it's a single large corporation or a consolidated group of U.S. entities, the ones listed on Form 851 detailing the parent-subsidiary relationships.
So if you're a company of a decent size, this is absolutely going to be a key part of your tax compliance puzzle. What about, say, cooperatives? Do they have to deal with this too?
Yes, good question. Cooperatives filing Form 1120C also fall under this rule if their total assets at year-end hit that $10 million mark or more.
Okay.
And interestingly, even if a corporation isn't required to file Schedule M3 because maybe it falls just below that asset threshold, it can choose to do so voluntarily.
Really? Why would they do that?
Well, maybe a company wants to demonstrate a higher level of transparency to the IRS. Or perhaps they anticipate growing beyond the threshold pretty soon and just want to get the practice established. It happens.
And are there any specific exemptions, like who gets a pass from this pretty rigorous reconciliation?
Yes, there are. There are specific exemptions for certain types of entities that have unique tax structures. So Schedule M3 is not required for corporations filing Form 1120 REIT.
Real estate investment trusts.
Exactly. Or Form 1120 RACA for regulated investment companies.
Wow.
Also Form 1120H for homeowners associations, and Form 1120 SF for settlement funds. These entities follow very specialized tax rules that just make Schedule M3 unnecessary for their reporting needs.
Now, that $10 million asset threshold sounds straightforward enough, but for consolidated groups, how exactly are total assets determined? I can imagine it getting a little tricky when you're looking at this web of companies.
It absolutely can get tricky. For a U.S. consolidated tax group, the total assets at year-end are determined based on the total assets of all the includable corporations listed on that Form 851 we mentioned.
Okay.
And here's a crucial nuance. It's net of eliminations for intercompany transactions and balances between those includable corporations.
So you don't double count assets just because they move between related companies within the tax group.
Precisely. You don't want to inflate the assets just because of internal movement. You look at the group as a whole after those internal transactions are netted out.
That's a really significant detail. Could you maybe walk us through a quick hypothetical scenario just to make that clear?
Sure thing. Let's use a classic situation, kind of like example 1 from the IRS instructions. Imagine U.S. Corporation A owns 100% of U.S. subsidiary B and also 100% of foreign subsidiary F.
Okay.
Now, for its current fiscal year, Corporation A prepares consolidated financial statements that include both B and F, and those statements report total assets of, say, $12 million. But when A files its consolidated U.S. income tax return with B, remember, F is foreign, so it's generally not part of the U.S. consolidated tax group.
Right.
The total consolidated assets reported on Schedule L for tax purposes are only $8 million, maybe after eliminating some intercompany balances between A and B.
Okay, so less than $10 million for tax purposes.
Exactly. So in this situation, even though their broader financial statements showed $12 million, the U.S. consolidated tax group of just A and B is not required to file Schedule M3.
Why not?
Because their consolidated Schedule L assets for tax purposes are below that $10 million threshold. This really highlights that it's the tax consolidated group's assets that matter for this specific threshold.
So it's not just about the total assets on any financial statement, but specifically those assets recognized for tax purposes within that U.S. consolidated group. Yeah. That's the key distinction. Could easily trip up companies, I imagine.
Precisely. It's a very common point of confusion. And just one more detail on that. For determining if that $10 million threshold is met, the corporation's total consolidated assets must generally be determined on an overall accrual method of accounting.
Okay.
Unless, and this is pretty rare for companies this size, All the includable corporations prepare their tax returns using a cash method, and none of them prepare financial statements on an accrual basis, but usually it's accrual basis assets.
Got it. Okay. And for those who do need to file, after all this meticulous prep work, where does this form actually go? Is there like a special secret address for the M3?
No special address, thankfully. That's a small relief in the world of complex tax forms.
Huh.
The standard filing address for Form 1120 and all its attachments, including Schedule M3, is just the regular Department of the Treasury, Internal Revenue Service Center, Ogden, UT 84201-00012.
Ogden, Utah. Got it.
Straightforward, but as always with taxes, super important to get it right.
Definitely. Okay, now that we understand the why and the who of Schedule M3, let's dive into Part 1. This section is all about setting the stage right, gathering the big picture financial info, creating that foundational starting point for everything else. When exactly do you complete this part?
Part I needs to be completed for any tax year that a corporation files Schedule M3. You can think of it as the grand entrance, really. It provides the fundamental financial statement information from which all the subsequent, incredibly detailed reconciliations are going to flow.
And a really critical step right at the beginning of Part I seems to be choosing the right financial statement. There's a very specific hierarchy here, isn't there? It's not just about grabbing any old income statement off the shelf.
No, absolutely not. It's quite specific, and the IRS lays it out very clearly on Part 1, Line 1. There's a definite pecking order.
Okay, what's the order?
It's top priority. If a corporation files a Form 10-K with the SEC, meaning it's a publicly traded company, they must use the income statement from that Form 10-K. That goes on Line 1A. No choice there.
Okay, SEC filings first. What if they don't file a 10-K?
Then, if they don't file a 10-K, but they do have a certified non-tax basis income statement, that means it's been audited or verified by an independent accountant. But importantly, not prepared solely for tax purposes, they have to use that one. That's reported on Line 1B.
Certified, but not tax basis.
Got it.
And if they don't have that either?
Then if neither of those applies, but they have an unaudited non-tax basis statement, maybe something prepared for management or lenders, but not audited, that's the one they have to use. That goes on Line 1C.
Okay, so 10K, then certified non-tax, then unaudited non-tax.
Exactly. It's a very clear hierarchy, basically forcing companies to use their highest quality, most broadly disclosed financial statements as their starting point for the M3 reconciliation. It pushes towards transparency.
That makes a lot of sense for transparency. But what is a company, maybe a smaller one, that still hits the $10 threshold, doesn't prepare any non-tax basis financial statements? Maybe their internal books are pretty much just aligned with tax rules already.
That's a relatively rare case, especially for the types of companies usually required to file M3, but it can happen. In that situation, you'd skip lines 2A through 3C. Those are the questions about the financial statements, and instead, you use the net income directly from your books and records on Part 1, Line 4A.
Okay, so there's an out for that.
Yes, it accommodates situations where the company's internal financial reporting is essentially its tax basis reporting. And there's another crucial rule here, too.
What's that?
The U.S. corporation that's actually filing the return must use its own financial statements, not the statements of a controlling U.S. or foreign parent company.
Ah, okay, even if the parent has consolidated statements.
Even then. This ensures the reconciliation starts with a financial picture of the entity actually filing the U.S. tax return.
Can you give us an example of how that parent company rule plays out? It sounds like it could be a common point of confusion.
It absolutely can be. Let's think about a scenario similar to example 4 in the IRS instructions. Suppose you have a foreign corporation, let's call it F, that owns 100% of a U.S. corporation, P, and P in turn owns some other U.S. subsidiaries.
Oh.
Now, F prepares these beautiful, certified, audited, consolidated financial statements that include P and all its subsidiaries. But P itself, the U.S. filer, doesn't prepare any standalone financial statements.
Right.
Even though F has those consolidated statements, P, as the U.S. entity filing the Form 1120 and Schedule M3, must not complete Part I by referring to F's financial statement.
So what does P do?
P would correctly check no on lines 1A, 1B, and 1C, skip all those financial statement questions, and instead report its worldwide net income based on its own books and records right there on Part Y, line 4A.
Okay, that makes sense. It keeps the focus squarely on the U.S. tax filer's own data.
Exactly. It ensures the reconciliation begins with the U.S. tax filing entity's actual financial information, not its foreign parent's potentially different picture.
So once the correct financial statement source is chosen, or you default to books and records, what exactly is reported on Part 1, Line 4A? This seems like the real starting gate for the whole reconciliation process.
That's precisely right. Line 4A is your absolute starting point. It's the worldwide consolidated net income or loss taken directly from your chosen financial statement source or books and records.
Worldwide.
Yes, worldwide at this stage. If it's a non-consolidated Form 1120, it's simply that single corporation's worldwide income. If you're a public company using your Form 10K, you'd report the consolidated net income from that 10K. And that number, as you can imagine, could include results from many U.S. and foreign subsidiaries representing the entire global enterprise from that financial perspective.
Okay, so we start really broad, the entire global picture from the financial statements. But for U.S. tax, obviously, not all of those entities included in that global financial statement might be part of the U.S. consolidated tax group. How do we start untangling that web, narrowing the focus down to only the entities relevant for U.S. tax?
This is exactly where lines 5, 6, and 7 come into play. They're crucial for this narrowing process.
Okay, line 5 first, foreign entities.
Right. On part 1, line 5, you essentially remove the net income or loss of foreign entities that were included in your big starting number on line 4A, but are not part of your U.S. consolidated tax group for tax purposes.
Why remove them?
Because foreign entities, generally speaking, aren't included in a U.S. consolidated tax return. You're backing them out. And you have to attach a supporting statement with details: their name, EIN if they have one, their net income, total assets, total liabilities. It's all about systematically isolating the U.S. tax-relevant entities.
Okay, so back out the foreign subs, not in the U.S. tax group. And I assume something similar happens for U.S. entities that aren't includable in the tax consolidation either.
Exactly the same principle. On part 1, line 6, you remove the net income or loss of U.S. entities that were included back on line 4A, but are not includable in your U.S. consolidated tax group for tax purposes.
When would that happen with a U.S. entity?
Often it's about ownership percentage. Maybe you own, say, 70% of a U.S. sub. For financial reporting under GAAP, you might consolidate them, but for tax consolidation, you generally need 80% ownership. So that 70% owned sub would be included in line 4A if consolidated financially, but needs to be backed out here on line 6. Example 4 mentions U.S. corporations DS-76 through DS-100, financially consolidated but not tax consolidated due to ownership. Their income gets removed here.
Okay, that makes sense. Now, what about other disregarded or includable entities on line 7? That sounds like a bit of a mixed bag, kind of a catch-all.
Yeah, line 7 is essentially for doing the opposite, adding back financial income. It's for disregarded entities like single-member LLCs, which are often ignored for tax purposes and their income just flows to the owner, or other entities that weren't part of the initial line 4A income but are includable in the ultimate line 11 figure for the U.S. tax group.
So it makes sure everyone who should be in the U.S. tax picture is accounted for, even if they weren't in that first big financial number.
Precisely. It ensures we capture all relevant entities for the U.S. tax calculation, regardless of how they were treated in the initial broad financial statement. Example 5 gives a good illustration with a U.S. LLC called N, which a corporation C treats as a corporation for its financial statements, but as a partnership for U.S. tax purposes.
Okay, how does that work out?
Well, C would remove N's net income on line 6A, because it's treated differently for tax. Then, on line 8, which we'll get to, it would reverse the elimination of N's minority interest from the financial consolidation. The net effect is that N's financial income isn't included in the Part 1 line 11 number for C's corporate tax, but its taxable income flowing through from the partnership K1 would then be reported later on Part 2 line 9. It's a crucial distinction.
This brings us perfectly to Part 1, line 8, adjustments and eliminations. This sounds like that reversal principle you mentioned earlier. What's actually happening on this line? It sounds complicated.
It can be, especially for companies with intricate consolidated financial statements. Line 8 is where you adjust for financial accounting consolidation or elimination entries. The key goal is to ensure that transactions between includable entities, those in the U.S. tax group, and non-includable entities, those outside the group, are not eliminated for tax purposes.
Okay, say that again. Not eliminated.
Right. Think about it. For financial statements, you might eliminate dividends paid from a foreign sub, non-includable, to its U.S. parent, includable. But for tax purposes, that dividend might be taxable income to the parent. So on line 8, you'd reverse that financial elimination to bring the dividend back into the picture for tax reconciliation purposes.
Ah, okay. You're untangling the financial consolidation to get back to a purely tax-centric view of those cross-group transactions.
Exactly. You reverse eliminations of intercompany dividends received from non-includable U.S. or foreign subsidiaries. You also correct for minority interest adjustments that were made for financial reporting but need to be reevaluated based on the tax consolidation rules.
So following that logic, if a company, for financial statement purposes, accounts for its interest in an entity using the equity method, maybe it fully consolidates it financially, but that entity isn't actually includable in the U.S. consolidated tax return.
Yeah.
You'd reverse the elimination of that equity income inclusion here on line 8.
Precisely. If the owner uses the equity method on its general ledger and then, for the consolidated financial statements, eliminates that equity income, that elimination must be reversed on Part 1, Line 8,
Right.
to ensure that the financial income from that non-includable entity, as calculated under the equity method, is properly reflected as you move towards calculating the tax basis income on Line 11. Example 5, again, illustrates this. A U.S. corporation, P, fully consolidates DS1 financially and uses the equity method. P would remove DS1's net income on line 6A, and then right here on line 8, it reverses the elimination of both the minority interest and the DS1 equity income. This ensures the equity method income remains part of the base for line 11.
Okay, that's subtle but important. Then there's Part 1, line 9, for income statement period to tax year adjustments. This seems fairly straightforward, but I guess essential for accuracy.
Yes, exactly. This line is necessary if your financial statement period doesn't perfectly line up with your tax year. Maybe your financial statements run on a calendar year, but your tax year ends on June 30th. You'd make the necessary adjustments here to reconcile those differences.
So it's just a timing synchronization.
Pretty much. It ensures that the income being reported for Schedule M-3 purposes covers the exact tax year being filed. Simple, but necessary.
And line 10, statutory accounting adjustments. That sounds pretty niche. Who uses that?
It is indeed quite niche. It's specifically for insurance companies, the ones filing Form 1120 PC, property and casualty, or 1120L, life insurance. They might need to make adjustments here to align their financial statement income with statutory accounting principles, or SAP.
ACP.
Yeah, those are often prescribed by state insurance regulators and can differ from GAAP. This adjustment is particularly relevant when dealing with intercompany dividends received from other insurance entities. It just ensures the reporting aligns with the specific regulatory framework for insurance companies before moving on.
Okay, so after all these intricate adjustments on lines 5 through 10, backing things out, adding things back, reversing eliminations, synchronizing time periods, what's the ultimate goal of Part 1? Where does it finally lead us?
The whole goal of Part I culminates right there on line 11, net income loss per income statement of includable corporations.
A magic number.
That's the number. This line represents the financial net income or loss of only the corporations that will be included in the U.S. consolidated tax return after all those systematic adjustments we just walked through.
Okay.
This adjusted financial income figure is the critical starting point that then flows directly into Parts 2 and 3. That's where the detailed income and expense reconciliation to actual taxable income happens.
So here's where it gets really interesting for you, the listener.
Yeah.
This entire process in Part 1, it's all about isolating the financial results of just the specific entities that are going to be part of the tax calculation. It's like the foundational work to make sure we're comparing apples to, well, tax-specific apples later on. Without this meticulous preparation in Part 1, the rest of the form, Parts 2 and 3, they just wouldn't make any sense. It's like clearing the stage before the main act begins.
Couldn't have said it better myself. It sets that crucial baseline.
All right, now that we've carefully sculpted Part 1 to get to this critical starting point, the financial income of just the entities in our U.S. tax calculation, it's like we've prepared our canvas, right?
Exactly.
Now in Parts 2 and 3, the real artistry begins. We start painting in all the differences that transform that financial picture into the one the IRS actually sees for tax purposes. And it all revolves around these 4 crucial columns. Can you break those down for us? These are really the core mechanism of Schedule M-3, aren't they?
Absolutely. These columns are the heart and soul of the entire reconciliation. Let's go through them. First, you have column A, income expense per income statement. This is your financial accounting amount. It ties directly back to that adjusted net income you calculated on Part 1, line 11. It's what the company reports in its books, often called book income.
Okay, book income, column A.
Then, jumping over to the end, you have column D, taxable income deduction per tax return. This is the U.S. income tax amount. This is the number that ultimately flows to Form 1120, page 1, line 28. It's the figure the IRS really cares about for calculating your actual tax bill. Call it tax income.
Book income in A, tax income in D. What about B and C in the middle?
Right, those are the bridges. Column B is for temporary differences. These are probably the most common type of differences you'll see. They're items where the financial and tax reporting treatment differs in timing, but the total amount recognized over the long run will ultimately be the same.
Like what? Give me an example.
Depreciation is the classic example. You might expense an asset much faster for tax purposes, maybe using bonus depreciation, than you do for financial reporting using straight line. So you get a bigger tax deduction now, but smaller ones later compared to book. Eventually, though, the total depreciation recognized over the asset's life will be the same for both. It's just a timing difference, like getting a tax break now that you kind of pay back later, or sometimes vice versa.
Okay, temporary differences are about when you recognize something. What's column C?
Column C is for permanent differences, and these are often the big ones, the ones that can be really surprising. These are differences that will not reverse. Ever.
Never.
Never. An item might be considered income for financial purposes, but is simply never taxed. Or, more commonly, an expense might be perfectly valid for financial reporting, but is never deductible for tax purposes. Think of things like fines and penalties, or maybe 50% of meals expense, or interest on tax-exempt bonds. It's a permanent tax benefit or a permanent non-deductible cost.
So if something is a permanent difference, it directly hits your current tax base with absolutely no future offset or reversal. That sounds incredibly important for any company trying to actually forecast its tax liability. It's like money that just vanishes for tax purposes, or maybe income that magically appears tax-free.
It is absolutely critical to understand, and the fundamental formula for every single line item in parts 2 and 3 is this. Column A plus column B plus column C equals column D.
Book income plus temporary difference plus permanent difference equals tax income.
You got it. And understanding those temporary and permanent differences is the absolute key to forecasting your tax liability accurately and really recognizing why your actual tax bill might be significantly different from your reported financial profits. Permanent differences, especially, directly impact your effective tax rate without any future reversals, so they are crucial to identify, track, and understand. They're kind of the silent killers of tax planning if you're not aware of them.
What if you're working on this, maybe late at night, trying to get the return done, and you're just not sure? Is this difference temporary or is it permanent? Is there like a default rule?
Yes, there is. And it's a strict rule designed to err on the side of caution and full disclosure for the IRS. If you cannot definitively determine whether a difference is temporary or permanent, the rule is you must report it as a permanent difference in column C.
Default to permanent. Okay.
The IRS prioritizes clarity and a complete reconciliation above all. Also, another important point. You have to report amounts based on the substantive nature of the item, regardless of what your financial statements might call it. So if your books call something provision for doubtful accounts, for Schedule M-3 purposes, it's functionally bad debt expense, and you report it on that line. Use the tax concept name.
And when do you combine these differences versus keeping them separate on the form? It seems like precision is really paramount here.
Precision is absolutely paramount. Generally speaking, differences that relate to the exact same item can be combined or netted together on that item's specific line. However, differences for separate and distinct items must not be combined.
Lumping.
No lumping allowed. Each separate item must be separately stated and adequately disclosed, even if the individual amounts seem small. For instance, if you have two different types of non-deductible expenses, say lobbying costs and fines, even if they're both relatively small, you can't just lump them together under other permanent differences. They need their own line item if one exists, or they need to be broken out clearly on a supporting statement attached to the other line. Detail matters here.
Okay, let's delve into part 2 then, focusing on some of the key income items and their tax implications. What are some of the most common categories here that trigger these book tax differences, especially when you're dealing with international operations or maybe complex investment structures?
Yeah, great question. When it comes to income, a really common area of divergence relates to foreign operations. For example, let's look at line 3, which covers subpart F, Q, E, F, and similar income inclusions. This is one of the most complex areas in all of international taxation.
Sounds like it. Subpart FQEF.
Yeah. Essentially, these lines capture amounts that you have to include in your U.S. taxable income under very specific Internal Revenue Code sections. Things like Subpart F income, GILTI, which stands for Global Intangible Low-Taxed Income and Income from Qualified Electing Funds, or QEFs.
Okay, can you just briefly explain what those are? Because GILTI sounds like something out of a spy novel, not a tax form.
It certainly does have a ring to it.
Ah,
Think of these rules, Subpart F, GILTI, as anti-deferral rules. Normally, the U.S. tax system lets companies defer paying U.S. tax on the earnings of their foreign subsidiaries until those earnings are actually brought back to the U.S. as dividends.
right. Deferral's usually good.
But Subpart F and GILTI are designed to attack that deferral. They force U.S. companies to pay tax on certain types of foreign earnings currently, right now, even before the money is distributed back home.
What kind of earnings?
Well, Subpart F traditionally targets things like passive income interest, dividends, royalties earned by foreign subs, or certain kinds of related party sales income. GILTI, which was introduced more recently in the 2017 tax reform, is broader. It aims to tax certain low-taxed active business income earned by foreign subsidiaries above a certain routine return. QEF income is specific to investments in certain passive foreign investment companies, or PFICs.
Wow. Okay, so the IRS is basically saying we're going to tax this foreign income now, regardless of when it hits your financial books.
That's the key takeaway for Schedule M3. These are tax-specific income inclusions. They're often not recognized as income in the same period for financial reporting purposes, or maybe not recognized in the same way at all. This creates significant, permanent, or temporary differences that have to be reported right here on line 3. It's a major divergence between book and tax for multinationals.
Okay, that makes sense. A way for the IRS to reach across borders and accelerate taxation on certain foreign income. What about lines 9, 10, and 11? These cover income loss from U.S. and foreign partnerships and other pass-through entities. Partnerships can be tricky enough on their own. How do they fit into the M3?
They absolutely are tricky, and they get their own lines here. On these lines, you report your distributive share of income or loss from these entities, partnerships, LLCs, taxes, partnerships, S-Corp, maybe.
Okay.
In column A, you put the amount that's reflected in your financial statements for that partnership interest. Then, in column D, you put the taxable income or loss amount that comes directly from the Schedule K-1 you receive from that partnership.
And these amounts can be different, right?
Yeah.
Even though it's a flow-through entity, there can still be divergences between the book income you record and the taxable income on the K-1.
Oh, absolutely. Very common. Let's look at example 13 from the IRS sources. Imagine a U.S. corporation, call it H, records $10,000 of income from its investment in a U.S. partnership, USP, in its financial statements. Column A is $10,000. But then you look at the Schedule K-1 from USP. After considering items reported on the K-1, like maybe certain partnership-level charitable contributions, or maybe some Section 179 expense that allows for immediate expensing of certain business assets at the partnership level, H's actual taxable income flowing through from USP might only be $7,800. That goes in column D.
So there's a $2,200 difference. Where does that go?
That $2,200 difference in this case is likely a permanent difference, maybe due to non-deductible items at the partnership level flowing through. So it would be reported as a $2,200 adjustment in column C. This just perfectly illustrates how even flow-through income, which you might think would be straightforward, can have significant book tax differences that show up at the corporate partner level on Schedule M3.
What about when partnership-level items get limited at the partner level? Like maybe the partnership made a big charitable contribution, but the corporate partner can't deduct its full share because of its own income limitations. That sounds like another layer of complexity.
That's a great point and a really common one, especially with things like charitable contributions or loss limitations. Building on that example 13 scenario, if that charitable contribution deduction flowing through from USP is limited at the corporate level for H, maybe because H has other investment losses that put it over the charitable contribution limit for the year.
Okay.
That disallowed portion, say it's $3,910, is not reported here on the partnership income lines 911. Instead, that disallowed $3,910 deduction would be reported over on Part 3, line 21, which deals with charitable contributions, and it would typically be reported as a temporary difference.
Why temporary?
Because those excess charitable contributions that are limited in the current year can usually be carried forward and deducted in future tax years subject to limitations then. So it's a timing difference. This really highlights how items can flow through for partnerships but then get subject to separate limitations at the corporate tax return level, creating these temporary differences that need careful tracking on the M3.
Okay, moving on down Part 2. Let's talk about line 17, cost of goods sold, COGS. This seems like it could be a really complex area for reconciliation, especially with inventory valuation and those tricky capitalization rules.
It definitely is. COGS is a major area for book tax differences. On line 17, you report differences related to things like inventory valuation methods, maybe you use FIFO for book, but LIFO for tax, or vice versa. Capitalization of costs under Section 263A, the UNICAP rules, which require you to capitalize certain indirect costs into inventory for tax purposes that you might just expense for book.
What else?
Also, differences in accounting for inventory shrinkage accruals, obsolescence reserve, and lower of cost or market LCM write-downs. Financial accounting often allows for reserves and write-downs based on estimates, while tax rules are often much stricter, only allowing deductions when losses are actually realized. These different accounting methods for inventory and cost capitalization are extremely common sources of both temporary and permanent differences reported here.
And example 18 in the instructions highlights this by showing depreciation and even meals being included within COGS for book purposes. That seems like an interesting, maybe unexpected combination.
It shows how intertwined things can get, yes. For financial reporting purposes, depreciation related to manufacturing equipment, and maybe even a portion of meals provided to production staff, might be allocated and included as part of the cost of goods sold calculation.
Makes sense from a matching principle perspective.
Right. But for tax purposes, depreciation has its own specific set of rules and deduction timing, often accelerated. And meals, as we'll discuss more later when we get to Part 3, are generally only 50% deductible for tax, while entertainment is often 0% deductible.
So how would that play out on line 17?
Well, let's say your financial COGS includes $50,000 of depreciation and $100 worth of meals. But for tax purposes, your depreciation deduction for that same equipment is actually $70,000, maybe due to bonus depreciation, and only $50 of the meals are deductible. This creates a temporary difference for the depreciation component, $20,000 favorable tax difference, and a permanent difference for the non-deductible portion of the meals, $50 unfavorable tax difference. These would be netted or shown separately on supporting statements for line 17, leading to potentially a very different tax COGS figure compared to your book COGS.
Okay, complex interactions there. Then we have lines 23A through 23G covering gains and losses on the disposition of assets. This seems like a pretty broad category for when companies sell off property, equipment, maybe even entire business units.
It is broad. Line 23A is where you report the aggregate financial gains or losses on asset dispositions, everything except inventory sales, which are in COGS, and gains losses flowing from pass-through entities, which are on lines 9-11.
So book gain loss on 23A.
Right. Then, lines 23B through 23G are where you report the corresponding tax gains or losses. This includes capital gains and losses that flow to Schedule D, Form 1120, the net gain or loss from Form 4797, which deals with sales of business property. And then there are specific lines for abandonment losses, line 23E, and worthless stock losses, line 23F.
What causes the difference between the book gain loss on 23A and the tax gain loss on 23BG?
The main driver is usually differences in the basis of the assets being sold. Because depreciation methods often differ between book and tax over the life of an asset, the remaining undepreciated basis when you sell it will likely be different. A different basis means a different gain or loss calculation. That difference in gain or loss gets reconciled right here.
Now, example 7 mentioned goodwill impairment. Where does that fit in? Because that's not really a sale or disposition in the usual sense.
That's a great distinction, and it highlights why you need to look carefully. Goodwill impairment is a charge taken for financial accounting purposes when the value of acquired goodwill is deemed to have decreased. However, for U.S. income tax purposes, impairment of goodwill is generally not deductible.
Not deductible at all.
Generally, no. It's a permanent reduction to your financial income that the IRS simply doesn't recognize as a tax deduction. Therefore, example 7 correctly shows that a goodwill impairment charge, say, $5,000 for financial purposes, results in a $5,000 permanent difference reported over on Part 3, line 26, which is specifically for amortization and impairment write-offs, an expense item section, and $0 deductible in column D. It does not go on the asset disposition lines here in Part 2 because it's an impairment expense, not a gain or loss from a sale or exchange. This is a very clear and often significant instance where a financial expense provides absolutely no tax benefit.
Okay, good clarification. Finally, for Part 2, there's line 25, other income loss items with differences. This sounds like the ultimate catch-all bucket for anything that didn't fit neatly somewhere else.
It is exactly that. This line is for reporting any other income or loss items that have book tax differences but aren't specifically listed on any other line in Part 2. The crucial thing here is that it always requires a detailed attached statement. You can't just put a number here without explaining exactly what it is.
What kinds of things might end up here?
Oh, it could be any number of unusual or less common items. Maybe income from a specific type of financial instrument with unique book tax timing, or perhaps adjustments related to state tax refunds if they're treated differently. The key is the IRS wants to understand every single difference, no matter how small or unusual. This line ensures that everything that doesn't fit neatly into another predefined category is still disclosed and explained thoroughly. No hiding allowed.
Okay, let's flip the script now and move over to part 3, which focuses on expense and deduction items. Expert, one crucial point right off the bat. The instructions say expense amounts in column A and deduction amounts in column D are reported as positive amounts here. That feels a bit counterintuitive for some people, doesn't it? And expense usually reduces income.
It can feel a bit odd at first, but it's actually consistent across the entire form, parts 2 and 3, and it's done for clarity. Think of it this way. A positive number in column A for an expense line means it was an expense that reduced your financial income. Similarly, a positive number in column D for that same line means it was a deduction that reduced your taxable income.
So if my financial statements show a $100 travel expense, I put positive $100 in column A on the travel expense line.
Exactly. And if, say, $80 of that is deductible for tax purposes, you put positive $80 in column D on that same line. It just keeps all the numbers flowing as positive inputs for the reconciliation math, A plus B plus C equal D, which makes it easier for the IRS to process and review consistently. You just have to remember that positive numbers on these Part 3 lines represent expenses or deductions.
Got it. Okay. And the very first item listed here, lines 1 through 6, dealing with income tax expense, seems like it would be a huge source of permanent difference. This is a big one, isn't it?
Yeah. This is indeed one of the most common and often substantial permanent differences. And it frequently surprises people who aren't deeply familiar with corporate tax rules. Financial statements following GAAP typically accrue for income tax expense, federal, state, local, foreign, treating it as a normal cost of doing business. This expense reduces the company's reported net income on its books.
Makes sense. Taxes and expense.
It is for book purposes. However, for federal income tax purposes, the federal income tax expense itself is generally not deductible. State and local income taxes are typically deductible for federal purposes and would be reported elsewhere, but the federal tax expense shown on your books is not.
So wait, you calculate your profit, you estimate your federal tax on that profit, you record that tax as an expense, which reduces your book profit. But then for the actual tax calculation, you have to add that federal tax expense back.
Exactly. You're essentially adding back your book federal income tax expense to get to your taxable income. Your financial statements show less profit because you've accounted for the tax expense, but the IRS essentially says, hold on, we'll calculate your tax on your income before you subtract the very tax we're calculating.
That seems circular.
It feels that way, but it makes sense from the IRS perspective. The tax itself can't reduce the base upon which the tax is calculated. So it's a classic permanent difference, an add back. Your financial net income is reduced by your book federal tax expense, but your taxable income is not reduced by that amount. Foreign income taxes might be treated differently, sometimes as credits. This directly leads to a higher taxable base for your company than what you might initially perceive just looking at the bottom line of your financial statements. It's a crucial reconciliation point on lines 1 to 6.
Okay, that's a big one to grasp. Now moving on to another area that's almost always adjusted. Line 11, meals and entertainment. This sounds like a critical example of a permanent difference that probably catches a lot of businesses by surprise, especially with recent rule changes.
It truly is. This is a classic permanent difference area. For financial statement purposes, companies might expense 100% of their business meals and entertainment costs. They see them as legitimate business expenses, for fostering client relationships, team morale, sales meetings, whatever.
Seems reasonable. You got to spend money to make money sometimes.
From a business perspective, yes. But for U.S. income tax purposes, the rules are much, much stricter, and they've gotten even stricter recently. Business meals are generally only 50% deductible under Section 274N. There are some exceptions, but 50% is the general rule. And entertainment expenses, things like taking clients to sporting events, concerts, golf outings, are now almost across the board 0% deductible under Section 274A.
0% for entertainment. That was a big change, wasn't it?
Huge change from the 2017 tax reform. Before that, entertainment was also 50% deductible, same as meals. Now it's basically gone as a deduction.
Can you illustrate that with a simple example? Say a company spends some money on meals and some on entertainment.
Sure. Let's use example 11 from the instructions. Imagine Corporation F incurs $200 in qualifying business meal expenses and $100 in entertainment expenses during the year. For financial reporting, the full $300, 200 plus $100 is expensed. So $300 goes in column A on line 11.
Okay, $300 book expense. What about tax?
For tax, only $100 of the meals is deductible. That's 50% of the $200. And none of the $100 entertainment expense is deductible, 0%. So the total tax deduction is just $100. That $100 goes in column D.
So column A is 300, column D is $100. What's the difference in column C?
The difference is $200, $300. This $200 represents the non-deductible portions, the other 50% of the meals, $100, plus the full 100% of the entertainment, $100. This $200 is reported as a permanent difference in column C. It's an expense the company paid, but it gets no tax benefit for $200 of it. This clearly demonstrates how a substantial chunk of a common financial expense is simply not deductible for tax, directly increasing your taxable income. It's a very clear illustration of a permanent difference hitting the bottom line for tax.
Wow, okay, that 50% and 0% rule really makes a difference there. And does a similar principle apply to line 12, fines and penalties? You pay them, they're definitely an expense hitting your cash flow, but you get no tax benefit for them either.
Yes, exactly. This is another key permanent difference category. Amounts paid for fines and penalties, especially those imposed by a government or regulatory body for violating laws, are generally not deductible for U.S. income tax purposes. This applies even if they are properly expensed for financial reporting.
Why aren't they deductible?
The underlying policy rationale from the IRS and Congress is that these payments are punitive in nature. Allowing a tax deduction would, in effect, lessen the sting of the penalty, partially subsidizing the penalty with a tax break. So, the law generally disallows the deduction. This means the expense directly inflates your taxable income relative to your book income because the cash outflow simply cannot be offset for tax purposes.
Okay, no deduction for punishment. Makes sense. What about lines 23, 24, and 25? These cover current year acquisition or reorganization fees. Things like investment banking fees, legal and accounting fees, other costs tied to M&A deals or restructuring. How are those handled?
This is a really interesting area where book and tax treatments often diverge, leading primarily to temporary differences. For financial reporting, especially for smaller deals or under certain accounting rules, some of these transaction costs might be expensed immediately as incurred.
Okay, expensed on the books.
But for tax purposes, the rules are often quite different. Many of these acquisition or reorganization costs may need to be capitalized.
Capitalized, meaning not deducted right away.
Exactly. Instead of being immediately deductible, these costs might be added to the tax basis of the assets acquired in the transaction, or in some cases, they might be required to be amortized, deducted gradually, over a set period like 15 years for certain intangibles.
So that creates a timing difference, right?
Precisely. It creates a temporary difference. You eventually get the tax benefit of the cost, either through future amortization deductions or maybe reduced gain when the acquired assets are eventually sold, but you don't get the deduction in the current year like you might for book purposes. It impacts when you can claim the deduction, effectively deferring the tax benefit into the future compared to the immediate book expense. This is reported on lines 23, 24, and 25.
Okay, capitalization versus expensing is a temporary difference. Then there's line 26, amortization impairment of goodwill. This goes back to our earlier discussion with example 7, where we said goodwill impairment was a permanent difference, not temporary.
Indeed. And this line covers both regular amortization of goodwill, if done for book, and impairment charges. As we discussed, goodwill amortization, the systematic expensing of purchased goodwill over time, is generally not deductible for U.S. income tax purposes, even if it's required or permitted under GAAP for book purposes. The same applies to impairment charges when you write down the value of goodwill because it's deemed less valuable.
So no tax deduction for that book expense.
Correct. A goodwill impairment charge of, say, $5,000 for financial purposes means you show $5,000 as an expense in column A on line 26, but you show a $5,000 permanent difference adjustment in column C and $0 deductible in column D. This is a very clear instance where a potentially significant financial statement expense provides absolutely zero current or future tax deduction. It highlights a fundamental difference in how intangible assets like goodwill are treated for book versus tax accounting. Tax goodwill from certain asset acquisitions might be amortizable over 15 years under Section 197, but that's a separate calculation from book goodwill impairment.
Okay, line 31, depreciation. This must be one of the most common and probably one of the largest sources of temporary differences for many companies, given all the different methods and bonus depreciation rules out there.
Without a doubt, depreciation is the poster child for temporary differences. Financial statements typically use depreciation methods like straight line and useful lives that aim to match the expense recognition with the asset's expected economic benefit over its life, following the matching principle.
Spreading the cost out evenly.
Generally, yes. Tax rules, however, are often designed with different goals in mind primarily to encourage investment in new assets. So tax law often allows for accelerated depreciation methods like MSCRS Modified Accelerated Cost Recovery System, shorter recovery periods, useful lives, and special provisions like bonus depreciation, which currently allows 100% immediate expensing for certain qualified property, or Section 179 expensing for smaller businesses.
So tax depreciation is often faster, bigger upfront.
Very often, yes. This leads to significant timing differences. Your tax depreciation deduction in the early years of an asset's life might be much larger than your book depreciation expense. Example 8 shows how a financial depreciation expense of $90,000 could translate into a $100,000 tax depreciation deduction, creating a $10,000 favorable temporary difference reported in column B. Of course, this reverses later in the asset's life when tax depreciation becomes smaller than book depreciation. But it's a prime example of why column B is so crucial. It tracks these significant timing differences that will eventually net to zero over the asset's entire life.
And line 32, bad debt expense. That seems like another common one, especially for companies that sell on credit. Does this involve reserves again?
Yes, exactly. This is another area where the use of reserves for book purposes clashes with tax rules. Financial statements under GAAP typically use an allowance method for bad debts. Companies estimate their uncollectible accounts receivable based on historical experience and current conditions, and they record an expense to increase this allowance or reserve.
Okay, estimating future losses.
Right. But for tax purposes, most businesses, banks are a major exception, cannot deduct bad debt expense based on estimates or reserves. Instead, they generally must use the direct write-off method. This means you can only claim a tax deduction when a specific debt becomes demonstrably worthless and is actually written off your books.
So no deduction until you actually give up on collecting.
Pretty much. Example 10 illustrates this perfectly. Let's say a company records $350,000 in financial bad debt expense for the year, mostly due to increasing its allowance for doubtful accounts based on worsening economic forecasts. That $350,000 goes in column A, but during that same year, it only actually wrote off $75,000 of specific customer accounts as uncollectible. Only that $75,000 is deductible for tax, so it goes in column D.
What about the difference? $350K book expense, $75K tax deduction?
The difference is $275,000. $350,000, $75,000. This represents the increase in the reserve that was expensed for book, but isn't yet deductible for tax. It's reported as a $275,000 temporary difference in column B. Why temporary? Because when those debts in the reserve do eventually get written off in future years, the company will get the tax deduction then, reversing this difference. This reserve method difference can significantly impact a company's taxable income compared to its book income in any given year.
Okay, that reserve versus write-off difference is key. Now, a really important one, particularly given the major changes in recent years, is line 35, research and development, R&D costs. The rules here changed quite dramatically, didn't they? This caused a lot of noise.
They did, and it was a huge shift, causing a lot of headaches for many businesses, especially those in technology, pharmaceuticals, manufacturing, really any innovative industry. Before 2022, companies could generally expense their R&D costs for both financial reporting and tax purposes in the year they incurred them. It was a nice alignment.
Simple enough, expensive when you spend it.
Right. But for tax years beginning after December 31st, 2021, that changed completely. Now, under Section 174, R&D expenditures, specifically defined, must be capitalized and amortized over 5 years if the research activities are conducted in the U.S., or over a much longer 15 years if the research is conducted outside the U.S.
Wow, from immediate expensing to 5 or 15-year amortization, that's a massive shift in timing.
Massive. It fundamentally changes the tax treatment and the timing of deductions for R&D spending.
So that obviously creates a major timing difference on Schedule M-3. Example 22 shows a company with $100,000 in R&D expensed financially in the current year. How does that play out for tax now on line 35?
Okay, so that $100,000 is the book expense, goes in column A. Now, for tax, assuming it's U.S.-based research, it has to be amortized over 5 years. And there's a half-year convention rule for the first year, meaning you only get half a year's amortization. So the tax deduction in year 1 would be $100,000 divided by 5 years times 1/2, which equals only $10,000. That $10,000 goes in column D.
Only $10 deductible for tax when you spend $100K.
In year 1, yes. The difference is a whopping $90,000. $100,000, $10,000. This gets reported as a $90,000 temporary difference in column B. It's temporary because the company will eventually deduct the remaining $90,000 over the next 4.5 years. But this is a critical timing difference that significantly increases a company's current tax liability compared to the old rules. It essentially defers those R&D deductions into future years, hitting cash flow now. It's a change that many companies are still grappling with.
Definitely. What if certain costs that a company calls R&D on its books aren't actually considered qualifying R&D expenditures under the strict definition in Section 174? For example, maybe it's research in the social sciences or humanities.
That's where you can get a permanent difference, and it's a really important distinction to make. The definition of qualifying R&D under Section 174 is specifically, it generally relates to activities intended to discover information that would eliminate uncertainty concerning the development or improvement of a product or process. Example 23 shows $10,000 spent on R&D related to social sciences. While that might be expensed as R&D for financial reporting, column A is $10,000, these costs are specifically excluded from the definition of allowable R&D costs under Section 174 for tax purposes.
So no deduction at all.
No tax deduction at all, ever. So you report the $10,000 book expense in column A $10,000 permanent difference in column C, and $0 tax deduction in column D. It's completely disallowed for tax. Similarly, example 24 notes that payments made simply to acquire the rights to use existing technology, even if booked as R&D financially, are generally excluded from Section 174 amortization and might be amortized differently or capitalized, often creating a permanent difference on the R&D line as well. These examples really illustrate that even within the broad category of R&D, you have to carefully analyze the cost to determine if the book tax differences are temporary, due to the new amortization rules, or permanent because the cost isn't qualifying R&D for tax at all.
Lots of nuances there. Okay, finally, let's touch on line 38, other expense deduction items with differences. This must be the ultimate catch-all bucket on the expense side for anything that wasn't explicitly mentioned elsewhere in Part 3.
It is, exactly. It serves the same function as line 25 did for income. And just like line 25, it always requires a detailed supporting statement explaining exactly what's included. This is where you'd report differences related to things like reserves and contingent liabilities that don't fit specific lines. Think about warranty reserves, restructuring reserves, maybe reserves for pending litigation or environmental remediation.
How are those usually treated?
For book purposes under GAAP, companies often estimate these future costs and record an expense and a liability when the obligation is probable and reasonably estimable. But for tax purposes, deductions are generally not allowed until the liability becomes fixed and certain and economic performance has occurred, essentially, until the cost is actually paid or incurred in a very specific legal sense.
So another timing difference.
Usually, yes. It creates temporary differences. The deduction is merely deferred until the actual payment or specific trigger occurs for tax. Example 9 makes a point that different types of reserve accounts, like reserves for accounts receivable, bad debts, covered on line 32, reserves for coupons or warranties, etc., must be reported separately here on line 38 or on their own lines, if applicable, not just lumped together as reserves. Example 26 discusses prepaid insurance, which might create a temporary difference depending on book tax methods, versus advertising costs, which might have no book tax difference if expensed similarly by both. The IRS uses this line 38 to ensure that all expense differences, no matter how unique or miscellaneous they seem, are clearly identified and explained.
So the takeaway seems to be that adequate disclosure with those supporting statements is really, really key for both Part 2 and Part 3. It's not enough just to put a number down. You absolutely have to explain what it represents.
Absolutely. You hit the nail on the head. Many, many lines throughout Parts 2 and 3 explicitly state that detailed attached statements are required if you report an amount there. These are not optional suggestions. They are fundamental requirements for a complete filing. They are crucial for providing the IRS with the necessary breakdown and justification for all the book tax differences. Without clear, detailed supporting statements, the reconciliations is essentially incomplete, and you're basically just handing the IRS a big red flag inviting questions or even an audit. The more transparent and well-documented your Schedule M3 is, the smoother your interactions with the IRS are likely to be. Full disclosure is the name of the game here.
We've covered a ton of ground on specific income and expense items and those crucial 4 columns. Now let's wrap up by looking at how Schedule M3 handles consolidation and some of the other complexities, especially when you've got groups of corporations filing together. How do consolidated versus consolidating Schedules M3 work when you have a big corporate family filing one tax return?
All right, this is important for larger businesses. For U.S. consolidated tax groups, meaning a parent corporation filing a single Form 1120 return that includes multiple eligible subsidiaries, it's actually not just one Schedule M3, which might surprise some people.
Just one. How many then?
Well, the parent corporation prepares one consolidated Schedule M3 for the entire group. This main M3 includes the consolidated Parts 2 and 3, summarizing the book tax differences for the whole group combined. But here's the kicker. In addition to that main consolidated M3, separate Schedules M3, specifically Parts 2 and 3, must also be prepared for the parent corporation itself, standing alone.
Okay.
And for each includable subsidiary corporation included in the consolidation, and even for a theoretical consolidating eliminations entity, which captures the adjustments made to eliminate intercompany transactions within the group.
Wow, so you could have dozens of these M3s for one consolidated return.
Easily, for a large group. It provides an incredibly detailed, really granular look at the book tax differences occurring at each level of the consolidated group. It allows the IRS to see the reconciliation both from a top-down consolidated perspective and from a bottom-up entity-by-entity perspective. It's definitely a lot of paperwork, but the goal is tremendous transparency into the consolidated numbers.
That sounds like a mountain of forms. What about these mixed groups you hear about, where you have different types of corporations under one consolidated umbrella, like maybe a regular C-Corp parent owning both manufacturing subs and insurance company subs? That must be a whole new level of complexity for M3.
Oh, it absolutely is. This is where Schedule M3 reporting gets particularly intricate, and yes, it adds a whole new layer. If a U.S. consolidated tax group includes corporations filing different types of returns, say Form 1120 for regular C-Corp, Form 1120 PC for property and casualty insurance companies, and/or Form 1120L for life insurance companies, it's officially designated as a mixed group.
Okay, mixed group. What does that trigger?
It triggers a requirement for what the IRS calls sub-consolidation. This means you essentially have to create subgroups within the main consolidation based on the type of return filed. You'd have an 1120 subgroup, an 1120 PC subgroup, and an 1120L subgroup potentially. And each of those sub-consolidations needs its own Schedule M3, Parts 2 and 3, prepared on a sub-consolidated basis.
So it's like a consolidation within the main consolidation. It's almost like Russian nesting dolls of tax forms.
That's a perfect analogy. It really is a nested doll of tax forms and reconciliations. And it doesn't stop there. A mixed group must also file a separate form, Form 8916, which is specifically titled Reconciliation of Schedule M3 Taxable Income with Tax Return Taxable Income for Mixed Groups. And potentially even another form, Form 896A, which is a supplemental attachment for certain intercompany transactions within the mixed group.
Good grief.
And on top of all that, there are complex checkbox requirements on the main Schedule M3 forms to correctly indicate that you're part of a mixed group and which specific type of entity, parent, subsidiary, 1120, subconsolidation, etc., that particular M3 represents. It requires some deep expertise in consolidated return regulations and insurance tax to navigate correctly.
So even more layers of reconciliation and disclosure for those mixed groups. Okay. What about the asset thresholds for full completion of Schedule M3? We talked earlier about the $10 million total asset threshold for needing to file Schedule M3 in the first place. Is there another higher threshold that dictates how much of the form you actually have to complete?
Yes, there is. There's a second higher threshold that determines the required scope of completion. Corporations that have total assets of $50 million or more at the end of their tax year must complete Schedule M3 in its entirety. That means Parts 1, 2, and 3.
50 million, so no shortcuts for the really big players.
Exactly. There's no optionality for these larger entities. Full detailed disclosure across all 3 parts is mandatory. The IRS clearly wants the complete picture of all book tax differences for companies of that size.
And what if you're required to file Schedule M3 because you're over the $10 million threshold, but you're below that $50 million mark? Or maybe you're filing voluntarily even though you're under $10 million. Is there any flexibility there? Can they skip Parts 2 and 3?
Yes, there's a bit of a potential break for those filers, the ones between $10 million and $50 million in assets, or voluntary filers. They have a choice. They can choose to complete the Schedule M3 entirely, parts 1, 2, and 3, just like the larger companies, or they can elect to complete only part 1 of Schedule M3 and then use the older, generally simpler reconciliation form Schedule M1 instead of completing parts 2 and 3 of Schedule M3.
Ah, okay, so they can use M1 for the detailed reconciliation if they're under $50 million.
Potentially, yes, but there's a crucial condition. If they choose this option, the amount reported on Part 1, line 11 of their Schedule M3, which is that adjusted financial income of includable corporations, must exactly equal the amount reported on line 1 of their Schedule M1, which is net income per books. The starting points have to match perfectly.
Got it. That offers some flexibility, a bit less burdensome perhaps, for those smaller required filers, which is a rare but welcome thing sometimes in tax forms.
It is. However, it's vital to remember one exception. Those complex mixed groups we just talked about. They must complete parts 2 and 3 for all their members, regardless of whether they are above or below the $50 million threshold. The inherent complexity of mixed group reconciliations means the IRS requires the full M3 detail from them.
Okay, no shortcut for mixed groups. And throughout all this incredibly detailed reconciliation, the IRS really seems to emphasize the power of disclosure, doesn't it? It's not just about filling in the numbers, it's about explaining them clearly and completely.
Absolutely. That phrase, separately stated and adequately disclosed, appears repeatedly in the Schedule M3 instructions. It's not just a suggestion, it's a fundamental requirement woven throughout the form's design. It means using clear, descriptive labels for every item. It means providing thorough explanations on attached statements for any lines that require them, especially the other categories.
What counts as adequately disclosed?
Generally, a difference is considered adequately disclosed if it's labeled in a manner that clearly identifies the specific item or transaction from which that book pack's difference arises. Vague descriptions are discouraged. This level of detail is crucial for the IRS to efficiently understand the nature of each reconciling item and ensure compliance without excessive back and forth. It's their way of making sure companies aren't burying significant or questionable items in vague other categories without explanation. Transparency is key.
So, after this incredibly detailed journey through Schedule M3, what does this all mean for you, the listener? Maybe you're involved in preparing corporate tax returns, maybe you're analyzing companies, or maybe you're just trying to get a better handle on the financial landscape of big business. What's the big takeaway?
Well, you've just completed a really deep dive into Schedule M3, a form that truly unveils the complex, sometimes fascinating relationship between a corporation's reported financial health and its actual tax obligations. Understanding how and why financial statement items get treated differently for tax purposes, it isn't just about compliance, about filling out the form correctly. It's really about gaining a much clearer picture of your company's true tax burden, understanding its effective tax rate, and being able to better anticipate future tax liabilities. It shows you the why behind the difference between the profit reported to Wall Street and the taxable profit reported to the IRS. Mastering this reconciliation is genuinely a powerful tool for achieving real financial clarity.
And for you, the learner, maybe a student or someone just keen on understanding business better, mastering a form like Schedule M3 means you're not just passively reporting numbers or just accepting a company's stated profits or tax expense at face value anymore. You're actively starting to understand the intricate financial ecosystem of a business. You can identify precisely where those crucial differences between book and tax arise, and you can appreciate the detailed, sometimes surprising, and often complex work that goes into accurate corporate tax reporting. It provides a level of insight that goes far beyond simply knowing how to fill in the blanks on a form. It's really about understanding the subtle yet incredibly powerful levers that impact a company's real financial outcomes and its relationship with the government.
Indeed, it's fundamentally about recognizing that concepts like income or profit aren't monolithic. They're not singular. There's financial accounting income, designed to tell one kind of story, primarily to investors and creditors following GAAP or IFRS. And then there's taxable income, designed to tell a different story, specifically to the government for calculating tax liability following the Internal Revenue Code. And the journey between those two stories, as we've seen, is filled with deliberate, legally defined, sometimes complex, and often very significant differences. Schedule M3 maps that entire journey.
So as you reflect on this journey through the intricacies of Schedule M3, maybe consider this. In our increasingly data-driven world where we have access to so much financial information, is the true profitability of a corporation best defined by its glossy financial statements? or by its meticulously calculated tax returns? Or, perhaps, is it most accurately understood through the intricate, highly transparent reconciliation between the two that Schedule M3 demands? And what deeper insights, what greater level of understanding might we uncover if all financial reporting embraced such transparent line-by-line reconciliation, truly pulling back the curtain on every single difference between economic reality and reported results? It's definitely a provocative thought for a truly informed financial mind to ponder.